Hey everybody, welcome back to SmartCon. I'm here with Stani Kulichov from Aave. Congratulations, Stani, for your growth, the #1 TVL locked on DeFi Pulse and other metrics. And also you guys launched this morning, the Wi-Fi pool we were just talking about today with almost 21 million locked in USD value locked in right now. So congratulations on all that.
Thanks, Andy. I mean, it was an actually asset that we've been tracking quite long. I mean, they have a good community, and the growth has been pretty much basis on the developers that are building on top of Aave. So a lot of credit goes to them as well. So thank you.
Fantastic. Well, we're super excited to have you here. So I'll let you take it away. Thanks.
Yeah, definitely. So you guys see my screen, right, on the presentation? I guess so. So. Today we're going to basically talk about unlocking value and what it basically means in DeFi, and also what has been the narrative in DeFi since now the short history. And like I will kind of like give some insights like how we think about value at Aave and what we are trying to achieve and like what makes us a bit different in terms of like how we try to reach innovation, and I think this will be very helpful. And also we show a bit of like how the composability works and how we're utilizing Chainlink, for example, in our price feeds, and how beneficial the whole ecosystem is in the Aave. So as kind of like a those who do not know, or those who even know, this is very interesting information in terms of like what Aave is. So, I mean, the Aave protocol. So in essence, it's basically a money market protocol, which means that anyone can come with stablecoins or cryptographic assets and deposit them into the Aave protocol to earn yield. And once you deposit to the Aave protocol, you will get in return interest-bearing tokens, A tokens. So basically, if you deposit DAI, you get A DAI. If you deposit USDC, you get A USDC. And what's cool about the A tokens is that they're actually algorithmically will increase in your balance, just as your for example, if you're an interest in your bank or payments accounts or whatnot, you will see basically credits there, so your balance increases. So, but I will go more deeply in the A tokens quite soonish. But in essence, so you can deposit and earn interest, and at the same time you can basically draw credit line against your deposits. So that's pretty cool. And when people are drawing those credit lines, it basically generates interest to the rest of the depositors. And because these are like the money markets are based on reserve, so each money market has asset-based reserve. Let's say there's Link reserve, Lend reserve, Wi-Fi reserve, USDC reserve, and so forth. And basically, since there's more deposits than borrows, it basically means that anyone can then withdraw at any time unless there's completely scenario where there's full utilization, which is quite rare situation. And of course, that liquidity that is in these money markets can be flash borrowed, and I will go a bit more further on that. But what's interesting about our protocol is that our expansion is pretty much horizontal when it comes to new money markets. So we basically want to open new kinds of opportunities for depositors and also borrowers that want to use their cryptographic assets as a collateral. And one of the money markets that we opened during this year previously was a Uniswap liquidity provider shares as a collateral. And what's cool about that is that actually those who are providing liquidity into Uniswap, they get basically this called liquidity provider shares that represents their position there, and they can use it as a collateral and borrow against. So it's kind of like a derivative on top of the Uniswap. And it's really interesting because we'll see a lot of DeFi composability happen in the future, where we see kind of like based on the tokenization, that liquidity is utilized this way with the tokens. And our goal at Aave is supply the users with money markets where they can access liquidity based on those tokenized shares. And in the future, we'll open a bit more in terms of money markets. So interesting about Aave is that we started in the protocol in January this year, and it has grown quite substantially. So typically in DeFi, we have this kind of like a metric or yardstick to measure things called TVL, total locked value, total value locked, and it's based on the DeFi Pulse kind of a way of looking how much users are trusting your smart contracts, how much they're putting value into them. It's not the best metric in sense of measuring success, growth, or adoption, not at all. I think it's just a metric in the beginning and was a kind of like a meme metric as well to measure how much funds are in balances in this smart contract, so how much people are actually trusting them. But what's cool about this metric is that it gives some compassing in terms of like how the growth has been. And in terms of Aave, so we started in January completely from ground zero, and we reached now basically 1.5 billion worth of value locked in the smart contracts, which is pretty cool. And we're the biggest now and most trusted DeFi protocol to this date. And it feels very good in the sense that kind of that the developers are trusting us, the community is trusting us, and also the price fees that we are getting. Basically, we are one of the unicorns that Chainlink kind of like in terms of value added, their price feeds are securing, and that is very interesting, kind of like a observation. And yeah, besides the value locked, I think like what's important in this kind of metric is to see that like most of the value comes from developers. People are building a lot of things on top of Aave. Our goal is to be the most developer-friendliest protocol that you can actually build new functionality, financial primitives, and we give all the help that we can and make sure that our documentation is clear as it can be. And this is how we create opportunities in DeFi, because DeFi is not just basically permissionless access, but it's also permissionless building. And this is how we create new kind of like a products, remove inefficiencies by creating new products for the end users. And of course, we do have a user interface. And basically what's interesting about our user interface is that we kind of understand that as a decentralized protocol, we want the Aave protocol to be accessible as widely as possible. And what's interesting in that is that we do have our own user interface, and we started with that because we want to show the community how easy it's actually to use our protocol and show an example to others. But anyone can actually tailor their user experience for their users, and or based on localizations or whatnot. So there's no limitations in what you could actually build in that sense. And our main money market has roughly 1.7 billion market size. It basically means that that's the deposit amounts and the borrowings in total. So the deposit markets and borrow markets. And you see in this image, for example, how this slide and how different kinds of asset markets different kind of assets we have there, and what are the deposit rates you will get when you're depositing into Aave, and the borrow rates. What's cool about Aave is the stable rate. This is something that people absolutely love, because the problem with DeFi interest rates is that they fluctuate quite a lot because they're based on mathematics of supply and demand and the utilization. And when you're able to basically take a stable rate, you are getting a rate that is predictable for you compared to a fluctuating rate. And that is very important, especially when we are in the era where there's different kinds of yield farming opportunities and people come to Aave to basically utilize credit as much as they can, and the rates are going up. But those who are actually on stable rate they don't feel the difference in that sense. So that's one of the coolest features that we have, and there's plenty of other cool features coming in our version 2, which is coming pretty soon. And it allows you to, for example, swap your collateral position. So if you deposit, for example, Ethereum, and you want to convert that to and you borrowed, let's say, DAI, and you spent that DAI already, but you want to change your collateral to, for example, from ETH to Land or to Link, that is totally possible. And we are adding this kind of like a features where you can do more swaps between your positions and are more user-friendly in that sense. And of course, we have the smaller markets. The Uniswap market is a bit more smaller because it's based on version 1 Uniswap. And we're rolling up new versions of Uniswap markets with the support of version 2. So this is something is quite cool that is going to happen. Yeah, and of course, one of the markets we're working now is the SET token markets. We wanted to basically get it out a bit quicker, but SET protocol is coming with version 2, so we want to add them both at the same time and rely more on the version 2. But I think it's just an example of like innovation, like what you could actually build and unlock in terms of like liquidity. So the very first idea the main point of Aave is that the users can come, deposit, and borrow and unlock that liquidity that they have. So that is like the main thesis of Aave. And this is just a small example of the composability that we have, all the different kinds of DeFi primitives, integrations that are actually using Aave and are somehow connected together. And I think the slide is a bit outdated, so I could double the amount of stuff is being built, but it just shows how diverse the space is. Aave, as a project, we started actually in 2017. Well, 2016, we started to build. We started the first project called ETHLend, which is short for Ethereum Lending. And that was the first actually on-chain lending protocol and first protocol where you actually are collateralizing positions. And that is what the whole DeFi is kind of based now in terms of lending and stable coins. And during that time, there wasn't that much ecosystem. So there was basically one decentralized exchange called EtherDelta. There was ETHLend. So it was very difficult to build different kinds of things. And now we have just so many interesting things on different layers, and people are building constantly every day new products and launching. And this is like very fascinating. This is why we love the space at the moment, because we see so much innovation. And Aave as a base layer opens like very good opportunities. I mean, you can build different kinds of derivatives, and you can store the derivative, for example, in the Aave protocol that earns at the same time interest, and that could be used to reduce the cost of the writing a derivative and also of buying that derivative. So there's so many things you could actually use Aave for your project. So yeah, I think things are only getting better. And yeah, so we have this concept called A tokens, and what is actually we're trying to achieve is a permissionless savings account. So if you open a savings account today in banks, you basically have to go a lot of paperwork, and after all the stuff that you do, you might get basically close to zero interest, or actually zero. And we're actually going towards more negative rates in some part of the world, and that is very interesting in the sense that might drive more interest into the DeFi. And A tokens are, in essence, interest-bearing tokens. So let's say when you deposit you deposit USDC into Aave, you get in return AUSDC, and that AUSDC will algorithmically grow in your wallet balance. And this is like how you kind of like create innovation. When we first had the idea, many in the ETH community were a bit of skeptical, because this is a kind of like an unorthodox way of creating tokens. But what's cool about this is that we got so much support from our community and also our users, that this is actually a pretty cool way, because everyone sees how much they deposited and how much they're earning in the protocol directly in their wallet balance, and they can use those tokens right away. And that's like very cool thing in our opinion. And it's basically US dollar nominated because of the stable coins. And yeah, if you send the tokens to someone else, for example, the balance still continues to grow. I could see in the future this could be a very efficient payment solution in the sense that actually have a payment currency that is increasing value all the time. And I think that's way better than a USD currency that actually decreases in value in terms of inflation. And this A tokens as a permissionless savings account is very beneficial if you live in a country, for example, where local currency is suffering quite a lot from the inflation, or you don't have access to US dollar nominated savings account, or the yields are basically suck. In that sense, like I see a lot of potential in the adoption, and the user experience is quite seamless because you don't need to deposit to Aave to actually get those A tokens. You can just buy them from the market, and they will increase in interest. Yeah, and you can also natively redirect that interest, so that's pretty cool. Yeah, and seeing your balance increase in your wallet, that is fun. Like that is really cool, at least for me. And yeah, the A token deposits has grown even like in terms of institutionals and people who are holding substantial value. So this chart shows the Gnosis safe and the increase of the different kinds of A tokens that has been utilized. So the interesting point is that holding A tokens is better than holding the underlying because you get the interest. And for example, you could be holding instead of holding Link, you could hold A Link, and at the same time you will be holding the underlying deposit and also the interest that you're earning. So that's pretty interesting stuff. And then another way we are actually unlocking value from the protocol. So we have these are the different examples how Aave in terms of like, ironically, we have most locked value now, but ironically, we are like trying to always think of ways to unlock that value. And this is our way of kind of like trying to figure out new features all the time. And Flash Loan allows users to borrow 100% under collateralized. And now what's interesting about Flash Loans is that you don't need any collateral and you can borrow as much as there's actually reserves available. And in current market value, there is 1.5 billion USD worth of assets in Aave. So technically, you could borrow all of those in one Ethereum transaction. And the catch is here that you actually need to return the loan as well in one Ethereum transaction. And basically, there's plenty of interesting use cases. But technically, how it works, for example, a developer might create a tool where he has some sort of like a searches for arbitrage opportunities. So you flash borrow from Aave, and then you buy a currency in one exchange, and then you sell the currency in another exchange. For example, you buy in Uniswap, sell in let's say Balancer, and then you basically keep the profit, return the loan back to Aave. So you basically made an arbitrage opportunity without using your own capital. Or you could do refinancing, for example. You basically took a loan with ETH collateral. You borrowed, let's say, USDC. You spend that USDC. So basically, what you could do a flash loan from Aave of basically USDC. Return that loan, take that Ether, sell it for, let's say, Link, and take that Link, put it back into the Aave, and draw that USDC credit back and return that into the flash borrow facility. And this all happens in one transaction, and it works because Ethereum settles per block. So each block has a certain amount of gas that you can utilize that determines how much transaction could be fitted into this block. And then each transaction can have nested transactions. So one transaction and multiple nested transactions. And then you have just in one transaction the the borrow, the buy, the sell, the take profit and return the loan, and so forth. So this is like a use case-wise very good tool for developers to build products for.
Hey, everybody. You can see we lost Stanny there briefly, so we're going to try and get him back and figure out what's going on. So hang tight. We are, we'll call this a small break, and we'll bring him back as soon as we can, and I will report back if there's any change. I think we are getting him back. He's back in our backstage chat. So I'll hang out here for just a minute. And we'll see if he's coming back. All right, he's taking one more moment. I'd love to see your guys' questions in the chats. We're trying to see them. We see your guys' comments in the chats as much as we can, but you're keeping the chat moving pretty fast, which is fantastic. Thank you.
Back here.
Hey, welcome back.
Yeah. Awesome. So now I have the screen share as well.
All right. Yeah, we were in flash loans, and you were talking about nested transactions and such there. So if you want to pick up there, I'm sure we'll get it back.
Yeah, definitely. Yeah. So basically, yeah. Hey guys. Yeah. All good. All good. Some minor technicalities. Yeah. So many people here. So many people. It's just amazing. It's just it's crazy to follow all of the stuff. But yeah, glad that you guys are here. So yeah. So the flash loans are getting insane. Like I've seen like 130 million per day. Like this is something like quite insane. I think at some point we'll move even a higher amount. So it's interesting to see like how things are going in the future. Yeah, and they like the cool thing about flash loans is that every flash loan gives a interest rate spike on that particular block for all of the depositors. So that's like interesting feature in that sense that it's kind of like an arbitrary interest rate. And third way or fourth way actually, if we calculate correctly. So how we actually unlock more value from the protocol is basically credit delegation. And the idea of credit delegation is that all the Aave depositors, so if you deposit at Link and you get a Link, you can delegate your credit line to someone else. So if you basically are there to only earn interest on your Link, Lend, Wi-Fi, stable coins, and you're not interested into drawing credit lines, you can delegate it to someone you trust, or basically to a smart contract. So the idea here is that 75% of the protocol value is not utilized, so it's there used as a collateral. So what's interesting here is that when you delegate your credit, you can actually earn more. And the base rule is that you can delegate it to anyone. You can delegate basically to who you trust. So if you're a friend to another Link Marine or there's options. But what's cooler, like what I'm very, very bullish and working quite intensively now is that you can delegate your credit into a smart contract that has predefined functions to do things, and that smart contract can't do anything else besides that. And for example, if you look at the Wirearn A-Link wall, it has credit delegation with 50% loan to value ratio, and basically that use a strategy to borrow stable coins from Aave protocol and to farm all kinds of crap. So, so that's the kind of like idea here, and with credit delegation. And I'm very bullish on this stuff, and you guys are going to see very interesting things coming up in terms of credit delegation version 2. And I'm personally like very fanatic about this feature, and I think it's a nice way to get utilization rate up and more interest for the depositors. Yeah, then we have basically one of the key points about DeFi is safety. So one of the things we have in our kind of like Avenomics, which is like the token economics, which determines like what our token holders are actually doing. So what they're doing is they're basically governing risk parameters on the Aave protocol, and that basically means that they're voting on different kinds of parameters, what basically is their loan to value ratio and so forth, or for example, what is the what kind of asset should be added into the protocol. And in return, they're basically doing risk transfer. So basically, the blend, or in the future of the migration of the token holders, they can stake into the safety module and earn more Aave. And the idea is that if there's some kind of like a shortfall event in our money markets, for example, failed liquidation, smart contract hack, or some sort of exploit, what's basically happening is that this stake will cover basically what will be the deficit. And if it doesn't cover, there is protocol recovery functionality, which allows basically this kind of like a minting for recovery. And we have a built-in backstop module for stablecoins to actually bid on those auctionettes. So the idea here is like not focus too much on the, well, we have liquidity provided incentives, but also like we are focusing more on the protocol safetiness. And I think that's the key for the adoption, because DeFi to succeed, this boils down to Aave, this boils down to Chainlink, this boils down to all the protocols. We can't basically mess up. We need to be very, very secure on how we basically build things. So that's kind of like the thing. Okay, sorry guys. Yeah, so there's a connection issues, but so this is the idea of like providing security is important. I mean safety, for getting more mainstream adoption and to avoid DeFi from failing. And that is basically what our Avenomics is all about, to providing safety for the markets. And also liquidity providers who are earning Aave, they're incentivized to bridge into the safety module and earn more and align in governance with the stakers. Yeah, so next step for Aave. So we're moving towards decentralized governance. The stakes are very high at the moment. We are doing it basically, that's our next step in our kind of agenda. And you can join the discussion governance at aave.com, and we're currently discussing about the balance of incentives and basically different kinds of discussions related to governance. And moving toward decentralized governance doesn't mean that the Aave team is leaving, or we will always be a stakeholder in the protocol. We always want to build things, but it just means that others can build, others can decide what we will build, and also it just widens the governance of the protocol. Yeah, and we have token migration coming, which we are focused upon, and new money markets. This is something, but also what's not in the slide, kind of like leaking a bit the alpha, is that well, already it's already has been leaked, but we are working on V2, which provides very extensive amounts of interesting features that will help the end users to swap positions and do all kinds of interesting stuff. So yeah, that was it. If you want to build Aave, docs@aave.com or Discord, but essentially you can join our Telegram from this link. And that was, thank you all.
Thank you so much, Danny. A great talk. It's been awesome to see just the evolution from ETHLin to now. So congrats, for the rapid rise over the last 6 months, 8 months.
Yeah, thank you.
Cheers.
All right, thank you all. Cheers.
So yeah, I guess nothing to be said, but it's just the beginning for Aave. Absolutely doing a great job. So for our next panel, we have Anthony and Eric from ETHub joining us. These guys recorded this specifically for SmartCon, and I really want to thank them for making this happen. So here's the debut of, is there still a in DeFi yield farming?
Hello, everyone. This is the panel about yield farming. Technically, the title is there still time to make hay in DeFi yield farming? So this is a very exciting topic. I guess quickly before we get going here, if you're not familiar with myself and Anthony, we're both co-founders of ETHub. Anthony also works at Set Protocol, and I myself, Eric, work at Gnosis. So we're going to spend the next 30 minutes talking about yield farming, what it is, and what the future looks like. So we're just going to kind of start with just a yield farming 101. What is yield farming? So Anthony, I'm going to pass it to you to kind of kick us off on, just what is yield farming?
Yeah, I think people get confused whenever they think about yield farming because there's a lot of noise around it. I think at its core, it's basically just like the concept of chasing kind of like the best yields available in DeFi. And the reason why people are doing this these days is because a lot of these yields are being subsidized by the different protocol tokens that are being issued. So we saw that kind of Compound kick this off back when they announced that people could earn the comp token by either depositing kind of their funds or lending them out on Compound or borrowing as well. So you could earn some comp tokens for doing that. And that caused this mad rush of people to come in. And then since then, we've just seen an explosion of all these different protocols offering up yield, their protocol token, and also the native yield of their protocol. So, taking Compound as an example again, you can still earn the native yield of, say, you deposit USDC. You're still earning a yield on that from other people borrowing it, but you're also now earning some comp tokens. But see, so this is the thing: these protocol token kind of like payouts aren't going to last forever, right? They're going. There's going to be on a kind of like a set emission schedule, and then once they've run out, there's probably not going to be any more. Some of them have like perpetual issuance schedules and all that, so we can get into that. But I guess, that's how I would define yield farming. It's basically the concept of stacking yields, and trying to find the best yield across like, DeFi on Ethereum, basically. But Eric, you might have a little bit of a different kind of definition to me.
Yeah, no, I definitely think that hits it home. I think we're like, this meme term kind of came about, which I do think defines it pretty well. But really, like at its core, it's startups, or even not necessarily just startups, projects that have been around a while, we've seen now doing this, finding a way to distribute their token, right? So this like yield farming term has kind of encompassed that, but I mean, really what it is kind of like redoing the 2017 ICOs in a very different way, which is a topic we're going to dive into as well. And is this a superior model and all that, which is a totally different debate, I guess, from, the basic 101 intro. But it's kind of like teams sitting back and say, okay, we want to launch a governance token. How should we do that? And because teams have working products now, they're able to say, hey, come use our product and we can kind of give out, we can give you yield. But in reality, they're giving out tokens, which speculators are buying up. And that's why, the yields are high. And on that topic, like, can these yields stay high forever? No, definitely not forever. I personally think they will stay high during the bull run because, again, like if you think about this, right? Say I launch Eric protocol and I'm giving away Eric tokens for people that come to my protocol and use it. Most of the time it's providing liquidity, right? So in the case of comp, people that are lending and borrowing, they're earning the comp token. So you're giving this away. And right now, because I think we're in a new bull market, embarking on one potentially, people are speculating on that coin. So DeFi is hot right now. People are willing to pay for these coins. In a bear market, this might be a different story, but because people I'm farming these, I'm dumping them, people are willing to pay for them. That means that the yields, we see APY quoted a lot. I don't think yearly interest is the best way to quote yield farming stuff. It's more daily or weekly, but because people are willing to buy this at a premium price versus what maybe, a year ago would have been, those yields look high. If there's no buyers, the APY is 0. So can these yields stay high forever? No. Can they stay high for a decent amount of time? I think so. We're already seeing them come down a little bit. Of course, if you're first and the project stays hot, they're going to stay high. We've seen examples of someone launches and like 24 hours later, we enter a death spiral and, you maybe were earning 5,000% APY, but now you're earning 0 or you got wrecked being a liquidity provider or something. But that's kind of my thoughts on it. What do you think, Anthony, as far as like, can these yields stay high? Like how long? Is this sustainable?
Yeah, I mean, you touched on the fact that it's currently, I guess, like a bull market or a hot market, as opposed to what it's been over the last 2 years. I think that plays a big part in it, right? Maybe the case is that we didn't see a lot of this stuff take off because of the fact that the market was quiet. The only example I can think of something that was very successful in terms of like an early yield farming program was Synthetics. So with Synthetics, they had a program where you could deposit your SNX as collateral into the Synthetic system, draw some SUSD against it, and then each week, depending on kind of like how close you were to your collateralization ratio, the system would pay you out in SNX tokens, but these tokens would be locked for a year, right? You couldn't actually sell them. So when you claim them each week, they're locked for a year from then, which is a bit different to what we're seeing today. But that was like an early example of yield farming. And that seemed to work during the bear market. SNX had like a amazing price growth during 2019, whereas now in this bull market, we're seeing obviously a lot of these tokens being bid up quite high. Like for those who are unfamiliar, there was recently one that Curve launched. So Curve is a stablecoin swap protocol, or a like-for-like asset swap protocol, because they have BTC as well. And they launched their Curve governance token, and this was pretty big because the initial supply of the Curve token was basically 0, and all the vesting started from day 1. The price got really crazy. So the fully diluted market cap got into the hundreds of billions for the first day or so. It's come down now, but it's still at around 10 billion fully diluted market cap, where most of the supply is still being emitted by the protocol. And because of this, the APY on Curve for yield farming is really, really high. So some of the pools have 200-300% APY, and that's, I mean, as you said, Eric, these things shouldn't be quoted in like yearly yield because of the fact that you don't expect them to last a full year. But people do that just to annualize it to make the flashy numbers. Like I personally like to look at, the daily yields and everything like that, because I know a lot of these things won't last very long. So yeah, in that respect, it seems like these things are going to be sustainable for a while, considering that the market, for some reason, wants to buy these tokens at such a high valuation. I don't know who's buying it. You know, sometimes some of these farms will actually incentivize people to provide liquidity on like Uniswap, for example, or Balancer for the different tokens. And what this actually does is it subsidizes this liquidity, right? Where the farmers can actually dump into the people that are providing liquidity in order to farm the token. So it's like this circular thing. That's not to say that the money isn't real, right? There is still money there. Like, just because you can kind of, you know, dump some tokens into liquidity on Uniswap doesn't mean the price is going to stay the same, right? If all people are doing is dumping, the price is going to come down, right? It's just that there's liquidity there because of the way that these AMMs or automated market makers work. But yeah, in terms of how long we're going to see it play out for, I think we can see this for years, especially if the market stays hot. It's just going to get crazier from here. And then, you know, even if it doesn't sustain these 100%, 200% APYs, as long as you're paying out a token as part of your kind of like protocol, it's going to be higher than if you were to just, give away that natural yield. So like, as I said before, Compound's yield is going to be higher with the comp token than it would be just from simply lending out your USDC and earning a yield on that, or your DAI or whatever other thing you want to lend out on Compound. So yeah, the 1000% APY stuff isn't sustainable at all, and you usually see that with what I like to call flash farms, so like YAM and YFI, that only last like a week or so. But maybe the 100% of the world will last for quite a while.
Yeah, I think an interesting movement we're going to see too are yield farming aggregators, which is what Yearn Finance Wi-Fi is doing, right? So because most people don't want to chase around yield with such high gas prices, you're going to get aggregated yield farming. So you're going to get millions, essentially billions of dollars in one like basket that's moving around and farming certain strategies. And that, of course, is naturally going to push yields down too, because there's now so much coordinated money. Like, a lot of these yields are high because we're new to this and a lot of people don't know what's going on or how to do it. So if you can just join a basket that's doing it automatically, it's definitely going to push it down. One thing I find interesting, I'm curious to get your thoughts on this, is do we think this is superior to the quote unquote VC model? So one thing that I'm giving my hand away a tiny bit here already, but one thing that interested me most about this is that this is cutting out VCs. Now, I actually do see the other side as well, of potentially this is dangerous because you're just dumping on speculators, and it's just as much insiders doing the yield farming as it would be VCs funding these startups. But let's start, Anthony. I want to hear your thoughts. Is this a superior model to the VC model that we've seen in the past?
Yeah, this has been like a hot topic of discussion among a lot of people. It's kind of like, is this the better model? Is this the best distribution model we can come up with? I think that there are still a lot of yield farming models out there that are just pretty much the same as like an ICO model, where the distribution is concentrated in, you know, a small group of people, right? Where there's a bit of a difference is something like YAM or YFI, where there's no, you know, VC allocation, there's no pre-seed or seed funding, there's no team allocation, there's no pre-mine. It's literally just that the teams launch this thing, and then it's kind of like a fair mining for all. So I guess they try to launch it in the spirit of, I guess, like what Bitcoin launched as, right? Where the network launched, and, you know, an email was sent out saying that it was live and you could mine it, and then everyone could get involved. Obviously, back then it was a very, very small group of people that could have gotten involved. So there's arguments to even say that these kind of like yield farming strategies like YFI and YAM are even more fair than Bitcoin's original launch, right? But, you know, this is completely subjective. Everyone has their own opinions here. Whether they're better than ICOs, I don't know, actually, because I don't actually think the ICO model was bad. What I think was bad was the tokens that were being sold were worthless, right? They were just utility tokens. They weren't actually governing over anything. They didn't do anything. A lot of teams just did it to raise money and didn't actually have a plan for what their token was going to do outside of some surface level stuff. So I think that there are some yield farming programs that are the same as an ICO, just that the emission takes longer. Whereas, they'll say, okay, 50% is for yield farming, and then 50% is for the team, for seed investors, for pre-seed investors, for future sales, like all this stuff. So I just think there's a little bit of a different trade-off here between the two, but I wouldn't say that it's better to the ICO model. The ICO model was just like a crowd fund, right? And there was problems with that. You had the fact that people were trying to put limits on, how much people could buy, so that whales didn't just buy everything. But that failed because the whales find a way around that, right? They always find a way around the limits. And the same with yield farming, where it's like whales dominate in yield farming too, because they have the most capital and they also can afford a lot of the gas. And as you mentioned, there's the yield farming aggregators coming out now, which actually level the playing field in terms of gas, which is really cool. But in terms of like capital, people with more capital are always going to get more. Like that's just the way that capitalism works. So I don't think that's the issue. But yeah, I personally wouldn't say that this is superior to ICOs. It's just a different model. But yeah, Eric, I'm curious on your thoughts here.
Yeah, I mean, interestingly, there's a lot more risk to this for people than the ICO model. I mean, obviously you have the price. It's interesting, right? Like farming, if you just farm and dump, you technically have no price risk. Your risk is that your capital you're locking up could be hacked or whatever. Like if the contract wasn't safe, although most of these now are just forking synthetics, minter contracts, staking contract, and so they're relatively safe. At least I don't put money in anything. At least I haven't betted a little bit, and wouldn't suggest anybody does. So the risk are just different. I guess if you bought into an ICO, the risk was that it could just go to zero. If you're farming, the risk is you could lose your capital. But if the price goes to zero, it doesn't really matter as long as you didn't buy and invest in it. So is it superior to the ICO model? Not necessarily. I agree with you. The issue with ICOs were people selling tokens that had zero worth, right? I do think governance tokens, I've been a little brutal on on-chain governance in the past, and I still am a bit skeptical, but at least if you own a share in governance, you can vote things in, like a share of fees, or like, in like YFI's case, you get a right to the treasury, or like that you could be bringing a lot of fees in the future and taking a part of that. So we're definitely seeing this emergence of this idea of treasuries that people could potentially have a right to, even on like a compound. They could vote in, taking fees for themselves and things like that. So not necessarily superior, just kind of a different way to go about it. And at the end of the day, it comes down to, does the project have a legit product that could be valuable in the future? That's what you want to look at when it comes to these things. As far as superior to the VC model, I know I showed my hand a little bit already, but yes, I absolutely think it is. There's a lot, at least in the US, there's a lot of debates around like accredited investor laws and, can people that aren't connected or have a lot of wealth get into, early investments and be their own VCs and things like that? The answer is really no. So this VC model gives, early entry to hyper-connected or certain individuals that eventually dump on market. Now, is yield farming perfect? No, right? Like, let's take Comp and YFI. If you had a lot of capital, especially a lot of stable coins, you could farm more than other people, right? Now, that problem is never really going to go away, but I do think we'll see an evolution of yield farming that kind of like has limits early on to kind of like allow people to have kind of equal access early on. Maybe those limits get lifted eventually. I think we saw something like this on Base token. There's so many out there at this point I can't even keep up. There's one for every like meal at this point, pasta and yam, and we got sushi coming. It's crazy. But I think we're going to see experiments with not just, hey, in 1 week, bring in as much capital as you possibly can, and you'll get this much tokens. I think we'll see different like curves messed with and things like that. But, I do think it's a much more fair launch. Like, hey, here it is. Like you said, it's just like Bitcoin. It's there. Anybody has access to it. So I do prefer this model. I think we're getting better as time goes on, and just kind of seeing where this goes will be interesting, because it's definitely, yes, yields might come down, but the yield farming, this whole concept is definitely not going away. On the topic of yields, this is actually something you and I recently talked about on our podcast, but I think it's a good topic. Do we think that DeFi in general, specifically yield farming and these high yields, are a threat in any way to proof of stake? Meaning, proof of stake on Ethereum has kind of a set curve. It does incentivize if there's a low amount of stakers, the yields are higher. As there's more stakers, the yields go down. But you're talking a range of probably 5 to 15%. We're talking right now about 100 to 300%. Do we see this as a threat to staking and kind of disincentivizing people from taking their ETH and staking it?
Yeah, I mean, as you said, we spoke about this a lot, and we continue to speak about this, and I think this is the talk of a lot of people within the ecosystem. Our general opinion is that, I mean, you're a bit different to me on this, but I guess my general opinion is that I don't think it's like a huge risk to staking. Guess like the main reason is that I think there's different people in the world, right? Not everyone's a profit maximalist. Not everyone wants to chase the highest yield. Some people are comfortable earning 10, 15%, even less than that on their capital, and that's fine for them, right? A lot of people like to do kind of economic analysis on this and say, okay, well, no rational actor would put their ETH into staking if they can earn much more doing yield farming. And it's like, well, that's not how the world works, right? People can be rational in different ways. You don't have to be rational. You don't have to be a profit maximalist to be rational. So I think while it does take away some of the kind of like flashiness of staking, and a lot of people probably won't stake now and will instead yield farm, I don't think it's going to be a major issue. I think there's a huge subset of people, especially within the Ethereum community, that hold ETH that are going to stake and would never yield farm, for example. I think there's a ton of people who might do both, right? They might stake with a bit of their ETH, and then they might diversify and do some yield farming with it. There's just different people and different risk appetites and different personas that I think we're going to see like a healthy balance between the two. And as we said before, it's not super sustainable, right? The yield farming stuff, it's not going to sustain that high. Whereas ETH staking is actually on a curve, as you mentioned. So it is sustainable in perpetuity. Now, your yields are going to go up or down based on, like, I guess, the dollar value of ETH. But in terms of percentage, and they'll go up or down, based on how many people are staking. But in terms of percentage, it's going to always be kind of known in advance, right? There's not going to be any gotchas where, the protocol token kind of like dumps and a flood of capital flows in and the yields dump or whatever because it's so volatile. I expect ETH staking to be a lot less volatile than yield farming, at least. So yeah, I think when discussing these things and when doing analysis on it, you have to take into account that different people will have different risk appetites and all that sort of stuff. You can't just say that everyone's a profit maximalist, and that means that it doesn't make any logical sense to put your ETH into staking.
Yeah, I definitely agree with you. There's diversification's key in general, and I think diversification and yield farming and earning these yields is going to be key. And staking is just a different form of yield farming, right? You're earning yield on your ETH. It's kind of like the OG yield farming, right? So it's in DeFi, it's been around a while. I guess SNX kind of was the original yield farming, like you mentioned earlier. But this idea definitely goes back to proof of stake as well. And yeah, I agree. Like there's 110 million ETH or whatever issued right now, and we don't need it all to stake, right? There's a point where there's kind of not diminishing returns, but the network's secure enough that we don't need more. And that curve starts dipping down towards zero quickly. And people, that's fine. Like some people will yield farm, some people will do nothing, right? Like a lot of people want to just speculate on ETH. They don't want to fire up a farm or a staking setup. They don't want to farm and things like that. So I do think it will bring down what we would have seen for a total staking target. And like this goes for any proof of stake network, right? Like Ethereum is the only one with DeFi right now, but if some of these chains were to evolve and have different yield options, I think just in general, the total stake amount will come down because people will diversify kind of out of staking into yield farming. What will be very interesting is like Yearn's launching a YETH vault soon. So people are going to be able to just directly earn yield on their ETH, which actually hasn't really been possible yet. Most of this stuff is using stable coins. Some of them have had wrapped ETH, but I think we're going to be talking pretty decent 20, 30, 40% return on ETH. And I think this will probably really push up that locked in DeFi number. So that'll be the true competitor, I think, to staking.
Yeah, and I think that, yeah, as you just mentioned, that why ETH Vault and just, I guess, direct ETH yield farming opportunities is what really competes with staking. Because you know, a lot of these other things are basically, you know, put in your stable coins or put in your DeFi token to yield farm. Yes, you can use ETH a lot of the time, but that's not the sole focus. Whereas if there's like a really popular kind of opportunity that you can use just your ETH for, then a lot of people are going to do it, right? And that's what's probably going to compete with staking. But again, I default back to my kind of opinions around different risk profiles, different personas, you know, diversification and all that sort of stuff. So yeah, long story short, still a little bit of an open question at how this is going to play out since ETH staking isn't live, but I wouldn't say that I'm worried about it.
Yeah, agreed. Next, just kind of quickly, how do we think this is going to evolve? Like, what's the next stage of yield farming? Is it better UX, better audits? How do teams find ways to do audits before they launch this stuff? Like, in your mind, we're in like the alpha version of yield farming. What does the beta version look like?
Yeah, we're in the experimental phase for sure, where everyone's trying different experiments with distribution, with yield farming, kind of like opportunities. UX. The UX is like terrible for most people. A lot of the time, I find myself going to Etherscan and interacting directly with the contracts, whereas most people aren't going to be able to do that. So I think Yearn Finance is obviously a leader here in making it really easy for people to get into these opportunities by putting them on autopilot. Us at Set, we're building kind of like solutions for this as well, so people can use like our really easy onboarding through our UX to get into yield farming. So yeah, because we're so early and because it's still experimental, everything's going to evolve. I think yield farming will look kind of like different next year than what it does today. It might look different the year after. We might keep iterating on it, just like we did with a lot of what's happened in Ethereum and DeFi, where DeFi was basically really hard and a toy like a couple of years ago, really hard to use. It was a toy. It was only for enthusiasts. Now it's like a powerhouse and it's growing exponentially. More and more professional people are getting involved now. More and more money's flooding in. So that's basically how it's going to evolve, I think. I'm really curious, though, to see how the distributions evolve, because we're actually seeing a lot of really horrible distributions come out now. A lot of projects issuing a token being like, this is for yield farming, and it's like a really low percent of it. And this is like, for our backers or whatever, for our investors. And I don't know if projects like that are going to succeed long term, but I don't know if the community kind of sentiment towards it is actually like a dampener on things, because we've seen tokens launch before that people are like, well, this is gross. And then the token just has a really high market cap anyway, because it's like a game where it's like, okay, well, I think this is gross, but I don't know if other people are going to think this is gross. So I'm going to buy the token because I'm counting on other people to buy the token, right? And it's like this game that people play. Having morals in this industry is really, it's funny. Like I don't like that it's this way, but having like strong morals is a way to stay poor, because a lot of people in this industry don't care about it. But I hope that it evolves over time and that we see more care put into these things and we see the bad distributions punished with like a low token price. But I'm not counting on it for now. Like we're still in, like, as we mentioned, the bull market's heating up. We're going to have a lot of new people coming in that just don't give a crap about any of this, right? They're just going to do what makes them money, and that's as simple as that. But yeah, I guess like that's like my cynical view. Maybe Eric, you have a more positive view on how we'll see this evolve.
Yeah, I'm obviously, I share the same cynical view, of course. I think we're still super early in all this stuff, and anytime speculators and greed gets involved, that's just going to be the nature of the game, at least for now. It is a totally decentralized, permissionless space. Like that stuff's going to be amplified, which we see all the time. And we definitely saw in 2017 and 18. How it evolves, I definitely think distribution is key. And we're getting better, right? Like, how do you find ways to make it fair and open to everybody to do? I think as far as evolution, it's definitely going to be this even easier access. So right now it's still very like if you've been in the space for years, you know what's going on. But if you're just kind of entering, you're not really sure, right? Like it's like, okay, well, you got to go to Compound and lend your ETH and borrow DAI. Then you got to take your DAI and put it in the Uniswap pool. And then you got to stake your LP token. It's like, come on, like that. Yeah, there's like 50 people that understand that. So I think this one click into yield farming will kind of be the next evolution of this. And then of course that's going to push yields down, and because more people are going to be getting into it. So, how sustainable long-term yields? Yeah, I'm thinking 15, 30% over the next phase, something like that, which is still very attractive, right? Like at least in the US in your savings account, you'll be lucky to earn 0.5% at this point. I guess just one closing note. What would you say is kind of if people are listening, interested in how to get involved with this? Obviously, all the disclaimers come with this. Most of these things don't have audits. You can lose your money. But if people want to get involved with yield farming, kind of what would you say is the easiest step right now?
Yeah, it's I guess like if you're chasing the highest yields, there's probably no easy way to do it. You have to get into the mud, into the dirt. You have to, go through all these things. You probably have to use Etherscan to manually interact with contracts. But in saying that, there are solutions popping up. So as we mentioned, Yearn Finance has these things called Y vaults that basically have your yield farming on autopilot. So you deposit some assets in, and then the vaults will handle all the yield farming for you. There's two fees involved. There's 0.5% withdrawal fee, and there's a 5% fee on subsidized gas. But I don't think it really matters because you're earning a lot more than that, right? You're earning a lot more than 0.5% in this yield farming thing. So yeah, Yearn Finance. Keep an eye out for what Set's going to be deploying in the coming months as well. But if you want to just get started today, yeah, put some stable coins on Compound. Lend out some stable coins, earn some comp there. Do it in Curve, stuff like MStable also has yield farming and opportunities. So there's a lot of opportunities out there, but right now for the one-click opportunity, it's Yearn Finance basically. If you want to get dirtier, you can go and do the protocols directly, but just know that you'll be paying like these high gas fees. You'll be having to manage it yourself. Because if you're a noob, you're starting out, you're going to not be able to chase the highest yields. You're going to make mistakes, but that's all part of learning. So I guess that's what I would tell people to do today.
Yeah, I absolutely agree on the Yearn Finance vaults. And I guess since this conference is powered by Chainlink, there is an Aave interest-bearing Link vault, which I think last time I looked was earning 50% APY or something like that. So that seems like the obvious choice. All right. Well, thanks everyone for listening. I think we could talk about yield farming forever, but I'm sure we'll, Anthony, I know you will on Twitter, probably continuing for the next few weeks or months, but thanks everyone for listening.
Awesome. Well, yeah, I'm excited for the evolution of DeFi and where it's kind of going. So my name is Dustin Goodwin. I work on Chainlink. I'm super excited to be taking you through the rest of the day. So our next talk is Too Much Liquidity, the state of automated market makers in DeFi. The race for DeFi's biggest pool is really intensifying. What separates one automated market maker from another? Does a winner take all? Is there room for many? Each project represented is utilizing the Chainlink network. This panel is moderated by well-known DeFi dad. He does a lot of DeFi tutorials, and he's DeFi dad in the Ethereal Summit. We also have Anton Bukov, Brandon Isles, and Andre Belikov. All right, guys.
Hey guys, can just making sure, can you hear me okay?
Yeah, you sound great.
Great. Hey, thanks for having me. Excited to be here. Let's go ahead and start with a round of intros, just because I know we've only got so much time, and I really want to make sure Anton, Andre, and Brandon have plenty of time to speak. So I'll start. I'm DeFi Dad. I am a super user. I'm an educator, and I'm an investor in DeFi. I think the awesome part about my role is I get to use all of the innovations that these guys build. So anyways, really happy to be here and excited to talk with all of you. And also, if folks are interested, go to DeFiDad.com. You can watch free DeFi tutorials. And I cover all sorts of Chainlink topics as well. So guys, who wants to start first? And also, maybe start out with, aside from who you are, give a pro and a con of AMMs, just to get us kind of like warmed up. maybe Anton, you want to go first? Or Brandon? Yeah, Brandon, you go first.
Sure. Yeah. So, hey, my name is Brandon, one of the co-founders of Ampleforth. Happy to be here and talk with you guys. Yeah. So our project has been very deeply involved with AMMs the last few months with the launch of our liquidity mining program. A quick pro con of AMMs. I think a pro is just the ease of use and convenience. I think a lot of people are going to these AMMs just because it's so easy to use once you have MetaMask style browser installed. You have to go through any multi-day waits for identity checks, that sort of thing. The cons are that the first generation of AMMs we've seen right now are very, very inefficient, right? So if you were to imagine like Uniswap existing on the New York Stock Exchange, I think it would very quickly be outmaneuvered by all the more efficient market participants. I don't think it would last very long. So that gives you a quick feeling of the possible headroom of improvements for these systems going forward.
Thanks, Brandon. Andre, you want to go next?
Hey, yeah, sure. Hi, I'm Andre. I'm a founder of Opium Protocol, and Opium is the platform to build derivatives within like 20 minutes. So we can build any derivative, just like in Bloomberg, in a ticker. And that's what we focus on. So of course, market makers, automatic market makers is a very important topic for us. And my background also is traditional finance. So I used to be a trader. I used to be a fund manager for around 10 years. I used to be in a traditional finance. And what I can tell that market makers, automatic market makers, it's not a new concept. So it's basically existing already for ages. And three main goals of the market maker is to provide liquidity. So that's number one. So that's the definition of the market making. Number two is to make some profit for the investors, for somebody who run it. And number three is it can be very different strategies. So I agree to previous comments that, it's not so much efficient at the moment in DeFi. And if we think about next 2 points, it's very, very poor, basically. So the making money for investor can be improved, and I can tell later how. And different strategies also not being run at the moment. So we've seen 1 inch is of Uniswap, and it's pretty cool. But it's so much more. So, and that's what I want to emphasize. So it's pretty cool that we've seen automatic market makers. It's amazing step, but if you look traditionally, it's very first step, and it's much more in terms of variety of liquidity, but also return to the investors and the pool.
Awesome, Anton, you want to go next? You have started an automated market maker, so you can be well equipped to answer this.
Yeah, I have like a skin in the game. Yeah, so I'm Anton. I'm co-founder of 1 inch. 1 inch is project which united all the on-chain dexes into a single huge dex. We tried to solve liquidity issue and build aggregation of all on-chain dexes to achieve like prices comparable to centralized exchanges and sometimes even exceeding them. And recently we launched our own AMM. We did some special architecture changes to solve some issues that we found with the existing automated market makers. We realized that most of them earn only fixed fee, but users, when they swap, they pay 2 different fees. They pay fixed fee and slippage fee. Slippage fee is depends from volume. The more users swap, the worse is the rate. The more is slippage, the more is fee. And we realized that almost no one of existing AMMs earn on slippage. They only earn fixed fee, and we tried to solve it.
Awesome. Let's go ahead and start off with talking about the strategy of just using AMMs, because everyone here, including Anton, again, who's actually started Uniswap, is using AMMs to help grow your platform. So recently, I'm trying to remember her name. I think it's like Martina Krug, Krug. Anyways, she's a great DeFi analyst, and she was talking about the fact that as we see more and more AMMs come to market, we're going to see competition, and that competition is all about making it more and more frictionless to move liquidity And basically, like, how do you maintain liquidity as an AMM? Like, how, like, which of these AMMs will ultimately succeed? So I'm wondering if each of you can sort of comment on this. And Anton, you'd have the most insight on this with MooneySwap. Like, how do you think about that? You know, MooneySwap has a migration for moving liquidity from Uniswap over to MooneySwap. I guess what I'm asking is, how will MooneySwap compete with future AMMs that try to do the same sort of thing and offer, you know, big sorts of incentives?
Yeah, I believe that since different AMMs give different returns to liquidity providers, it seems like liquidity providers will equilibrate these APRs among different protocols. And this would finish that some projects, some AMMs will have higher liquidity, some have lower liquidity, but they will have like pretty the same APR, but not like exactly the same, because it's like for liquidity providers, it's like trade-off between APR and risks. When they see new protocol with high APR, for example, they also understand that they have higher risks. They after they like wait for 1 month, 2 months, and they see that protocol is not hacked, is working like as expected, they more trust this protocol, and this is like a risk APR trade-off. So I mean, market is trying to equilibrate all the APRs with all the risks, and liquidity will be somehow distributed. I don't like believe that some AMM would capture all the possible liquidity. If some AMM is like twice efficient as any existing AMM, it will at the end capture twice more volume, twice more liquidity, and it will have like exactly the same APR possibly. So yeah, we built migrator as was like proposed, and the idea belongs to Martina Krank. Yeah, but it's like the first stage of this migrator, that it would just allow migrate liquidity, because we came up to idea that we could bring expand this idea to all AMMs to allow people to switch between different AMMs without needing to convert any assets. If you have like DAI and Ether in some pool and want to switch to pool of like different AMM of the same tokens, you can switch without conversions. And we're gonna also offer this service as one of sub-services of our aggregator.
That's actually, can I just continue? Because that's actually a really good point. Anton said about different risks, and this is a technical risk, this is the risk of the execution of the protocol, so on, so on. But there are much more risks in the market, and there is risks like of Ethereum going too high, or you think Ethereum going down. It's a lot of market risks, not only credit risk or technical risk, but a lot of market risks. And if we continue this logic into the accepting more risks, then we can imagine it's going to be much more different market makers who are just not neutral to the risk. They can say, okay, I'm going to accept this risk, certain market risk, and I'm going to make more money for you. So do you think Ethereum going to collapse? No. Okay, then I can build a market maker, which on this assumption, going to make it 2 times more return or significantly more return. But if you're wrong, if Ethereum going to collapse, then sorry, you lose significant part of your investment. And a lot of people could choose for it. And this is only one example. It's only one risk. So you can imagine it's going to be very a lot of strategies. And we're talking now about just spot market, about decentralized exchange from one asset to another. And then make it more complex. We're talking about derivatives. And we're talking about, when we talk about derivatives, amount of different risks or possibilities to take risk or sell risk is 100 times, 1,000 times more. So you can build, again, much more different market makers, strategies, which a lot of people would like to take, or another way around, they want to be safer. They want to have a strategy that generates less money, but it's more safe, not only technically or credit risk or anything what we're discussing right now, but also in terms of the market risks. And that's pretty cool. And that's my point that probably in a year time, 2 year time, we should see the scaling. So we should see that the market making should be done on a layer 2. And one of the things we do in Opium, we say that blockchain is only settlement layer, and we're trying to do everything at layer 2. So far, it's successful, but okay, it depends how much we're going to grow. Just want to drop this idea that it can be many risks, many strategies. What we're going to do if we grow 1,000 times, if we grow 10,000 times what everybody expects. So what is it going to be then?
Yeah, I think a lot of the conversations around AMM design tend to be framed around almost a zero-sum trade-off between design decisions. So for example, if LPs earn more fees, that means less volume on the exchange, or if there's less slippage, then there's more impermanent loss, or if there's exposure to only one asset, then there's less capital efficiency of those. And I think that's only half the story. I think if we go back to where we think AMMs can improve, right? We can kind of compare them to traditional market makers, right? I think it's going to be improved by having access to more information, right? So that extra information can either be information about the marketplace. So for example, if there's an oil shortfall, a traditional market maker would normally update their prices in response, right? Or if there's a period of high volatility, they typically kind of remove their liquidity from the books, wait for the market to find the next settling point, and then add it back on, because that's a period of uncertainty and they don't want to get railroaded. Then there's also information about the assets that they're dealing with, right? So Uniswap is kind of a jack of all trades. It doesn't really do anything special based off of what assets you're swapping. But Curve is an example of an AMM that makes use of the information just dealing with 2 different stablecoins, for example. So it can give you very efficient pricing specialized to that use case, right? And so I think also just due to the way AMM innovation happens, right? Innovation happens in the space different than what you'd see in like the Linux kernel, right? It's not the case that everyone just improves the same kernel or the same AMM moving it forward. Like every new feature or new innovation kind of results in a new AMM platform being launched, right? So going forward, I expect we'll see like an explosion of different AMMs specialized for different use cases, different assets, or making use of different market information. Which means that aggregators like 1inch, I think, will become much more prominent in the user experience of DeFi. I think more and more people will be going to aggregators like 1inch, and then whatever AMM happens in the background will be sort of like what TCP/IP is to web users. So that's sort of the way I expect to see things moving. And scalability on layer 2s, I think that's a great nice to have, right? But we do have DEXs that use layer 2s like IDEX and Diversify and the Bring, that sort of thing. But it's still the case that the convenience of Uniswap, I think, is bringing users. So I don't think that scalability is going to be a driver in the short term. In fact, it might even fracture liquidity, right? If we have different layer 2s in combination with this explosion of different AMMs in the space. So that's sort of where I see sort of the AMMs going from here.
That's actually really, sorry, I interrupt you.
No, Andre, go ahead. No. This is a panel. You guys should bounce off.
Oh, that's the panel. Oh, okay.
Yeah.
It's really interesting what you say about the information, because what we see in traditional finance, the company is trying to build the fastest optical cable between Chicago Stock Exchange and their exchange. They're trying to move as close as possible to the Chicago Exchange and put the best cable and so on and so on, because information is everything, and information that's basically the value in a finance. And at the moment, automatic market makers we have, they uninformed. They always going to lose to informed market maker, and there's much more. So they also good in mean reverting or only in mean reverting type of strategies. That's another story, and we can speak about it. But yeah, so I just want to emphasize that information is super important. And your second comment about that we have it and everybody still use Uniswap or other projects, I think it's a matter of money. So people nowadays in DeFi, they want to make money. And if somebody builds a market maker that's gonna bring you 2-3 times more money, so better API, they will switch within no time, I think, within 1 day. So what we've seen with Uniswap, it was a lot of liquidity from the first day. So if you offer something which brings better return for risk, that's not a question, I think.
Hey, Anton, did you want to add anything to that? I know we just went full circle again here. Anything else you want to add to that?
For sure. I'm wondering how many AMMs were launched exactly this year, because from like January we had Curve launched and like appeared. It's like specialized AMM for stable tokens of single asset, like stable tokens of Bitcoin, stable tokens of USD, and potentially of any other stable token, any other stable tokens. And we saw Uniswap version 2. We saw Balancer appeared. We saw also Banker version 2 with single token exposure. And some of them have no dependencies, like Uniswap and Balancer. They're both based on the formula of Alan Liu from Gnosis. He wrote all these formulas in his article on Medium in 2017. But some of them are like aware of oracles. For example, Banker 2 partially depends on oracles, but also can proceed without them on like previous on like algorithm, which is like similar to other AMMs. And yeah, as Andrew said, they are like oracles. AMMs are not aware of actual information, and some of them who are like relying on oracles, they have also to check this and verify, like because oracles updates not too frequently, and always it's like oracles update after changes of the price of 0.5%, and it's huge. And if you want to avoid Oracle front running, you have to set up fees similar to 0.5%. It's like direction, so your spread will be like 1%. If you want to just avoid Oracle front running, because anyone can see price movements before Oracle can get this information. And if you don't want to lose on it, you have to possibly get information faster. We also saw new kinds of oracles, which works faster than on-chain oracles. Let me remember, Coinbase oracles, possibly. They do provide signature and with exact timestamp of value. So you can bring value with your arguments of transaction. It will be like most up-to-date than on-chain oracles, which are updated by separate transactions. But it's not exactly like the fastest way to deliver information. But that's also an issue of blockchain, because the blocks are produced every 15 seconds. You can't like have a faster way to deliver this information, because you don't have way to faster process this information. Sure.
Anton, I think you mentioned another time that you did the research and that arbitrageurs, they make much more money than actual pools, and that is exactly the point. So the pools are losing because they're informed, and arbitrageurs, they are informed, and they see the price drop. They go to let's say Uniswap, and they start to make money, and on expense of the investors of that pool, because there is no information on Uniswap. And if you build this information there, it's going to be automatically repriced to the new values, and you don't lose the money of your investors to the arbitrageurs. And that's really interesting what the guys did. They actually calculated, and it's true.
Yeah. So on that note, Ample and Balancer have a really interesting integration launching fairly soon, where we can have a smart pool that's connected directly to the supply policy of Ample. So when the supply changes, it can, inline in the same transaction, dynamically update the weights in the smart pool to automatically update the price as well. So that removes a whole class of impermanent loss from LPs in that scenario.
Guys, I have a question. Something Andre was saying. Oh, sorry, guys. Was that Anton?
Yeah, let me add shortly.
Go ahead, Anton. Go ahead.
Okay. Andre, thank you for your great addition. Yeah, that's exactly the issue we tried to solve, because when we calculated how much arbitrageurs earned, how much users lost on the slippage, we realized that liquidity providers' earnings are not enough, and we tried to solve exactly this issue. And we were wondered when we found that our solution, which we came up to, was also proposed by Vitalik Buterin in 2017, but he was tried to achieve a different goal with the same solution. He tried to fight front-running attack. He proposed exactly the same solution to fight front-running attack. So when we came up to this solution from different perspective, trying to grab some additional revenue for liquidity providers from arbitrage traders, we were got front-running protection for free, developed by Vitalik Buterin.
But still, it sounds like all the formulas and approach we use is from 2017, so we have very old algorithms. Let's build something new.
Yeah.
Guys, by the way,
Yeah,
we still have time, but I think we probably have to wrap up in about 5 minutes or so. So, and this is awesome. This is a much more organic conversation. I actually wish we could talk longer and go deeper on some of this, but just so we kind of cover, to finish off then, to kind of cover some of the grand visions you have for AMMs over the next year, because I think it's hard to look further out than a year right now. Everything is happening so quickly in DeFi. So if you zoom out a year, how do you all see the landscape of AMMs? Anton was mentioning earlier, Curve only launched back in January. It's hard to believe all these things have been happening, but it's only happened really over the last 6 to 12 months. So anyways, how do you see the landscape of AMMs? How do you see those AMMs competing with one another? And also I'm curious, not just about how they compete with one another, but how do they compete with centralized exchanges? How close are we going to get to flipping centralized exchanges in terms of trading volume? I mean, is that really that far out, or will we see greater stablecoin liquidity in AMMs over the next year versus what we see on the centralized exchanges? Anyone want to go first?
Well, yeah, sure. I dream that in 1 year is going to be layer 2 still. Maybe Brandon not going to agree with me, but in order to compete with the centralized exchanges, in order to play on the same level, so the fastest blockchain still I don't know how many million times slower than actual trading in a traditional system. So in order to do so, we need a lot of speed, we need a lot of different strategies, and the competition is going to be done on the return, actually, they're able to generate or not on the risk. And users are going to be more informed, they're going to choose something appropriate for them, the risk and return level. And I really hope or believe that maybe not in 1 year, but in 2 years, it should be like the layer 2 play, because it's algo trading. It's already invented, so there are a lot of companies who do algo trading, and that's much broader than just automatic market making. So that's my dream.
Anton, Brandon, you want to go next?
Sure.
Yeah. I mean, you haven't launched MuniSwap. I'm very curious to see how you envision the future here. But yeah, Brandon, sorry, go right ahead.
Oh, sure. Yeah, so I think we'll see a Cambrian explosion of different AMM platforms, all doing specialized use cases very well and more efficiently than others. I think the competition is going to be very fierce between these different players as well, based off of trading fees, returns to LPs, that sort of thing. It's going to come down to how efficient they are. To add more to that, Ampleforth is also planning to design an AMM specialized to the Elastic token use case, like Ample, that has information about equilibrium bands, dynamic states, and equilibrium states. So kind of a combination of Balancer and Curve and Uniswap all together. As far as algo trading on DEXs go, my feeling is most algo traders are already algo trading on centralized exchanges. So I don't know if decentralized exchanges are definitely a big draw for them. Of course, scalability is great. So if we have greater scalability, that's better than not having scalability. But I don't think that's the main driving factor for people who use DEXs today.
Cut out.
Yeah.
Anton, you got 30 seconds, I know, and then we got to cut to the next talk.
Okay, I'll try to fit in. I wish to see a lot of different AMMs which behaves differently and earns differently on different market conditions. Some of them could earn high volatile markets. Some of them could earn for different liquidity providers who want to expose only one asset. And like the more different AMMs we will see for different purposes, which are like efficient in their own conditions, the more users will benefit because we can aggregate them all in some DEX aggregators, so like 1inch and any other.
Awesome.
So much, everyone. I know we got to cut out. Dustin, you can carry on, but thanks again. It was wonderful to get to join this, and thanks so much, guys. Brandon, Andre, Anton, you guys rock.
Thank you so
Thanks,
much,
guys.
Yes.
Anton at the top of the hour is out also leading a talk in the sessions if you guys want to hop over there and check it out. So I appreciate everything that, from the automated market maker perspective, it looks like there's going to be a lot of additions here in the future. Moving on, we're talking about DeFi composability, designing usable money Legos with DAOs and games. So getting into the Web3 space can overwhelm a new user, but smart contract design can smooth out that friction. We're going to talk to some of the leading teams about design and gaming and DAOs, along with the need for an Oracle solution. This panel is going to be led by Priyanka Desai of OpenLaw and the Lao, and then we're going to have Alex, Alexander, and Corey on this panel. Thanks, guys. Take it away.
Hey, everyone. Thanks, Dustin. So Priyanka here from OpenLaw and the Lao. Thanks for joining this great panel with our guests, Alex from Engine, Alexander from Axie, and Corey from DMM. Today, we're really going to talk about the cross-section of DAOs, DeFi, gaming, and the tremendous potential there. Actually, on the OpenLaw side, we're also contemplating an NFT DAO, just to throw that out there. And this topic is very, very hot right now, so I'm excited to get going. So I guess just to kick things off, it'd be great just to get a brief introduction from all of you and maybe a super quick description of what you guys are doing. So maybe Alex, I'll start with you.
Hey everyone, I'm Alex from Engine. So Engine is providing a suite of blockchain products that basically enable anyone to easily interact with the Ethereum blockchain, managing, exploring, distributing, and integrating blockchain assets into their projects. So comprised of the Engine platform, the Engine marketplace, an Engine wallet, our Beam distribution product, and many other tools and services, we're helping a whole range of different projects integrate blockchain into their vision. My role is head of developer partnerships at Engine. So I oversee relationships with more than 30 projects and partners who are using our platform currently. And I also lead the outreach. So basically from hour to hour, I'll be having a conversation assuming zero blockchain knowledge as someone's interested in using our technology. And then later I'll be talking to other people in the blockchain community and having to understand all of these yams and working out if I'm a Chad or a Karen. So really excited to have this conversation and discuss DeFi and gaming.
Awesome. Alexander, it'd be great to hear a little bit from you too.
Yeah, thank you, Pri. So my name is Alexander. I'm one of the co-founders of Axie Infinity and Sky Mavis. I also serve as the secretary of the board on the Blockchain Game Alliance. And in Axie Infinity, we're making a digital pet universe where players can use their cute characters in many different kind of games. We're frequently ranked as one of the top games on Ethereum, if not the top games on Ethereum, and kind of getting a little bit recognized for pioneering this whole play-to-earn aspect of gaming. And now we're also moving into, I should say, DAOs and that kind of thing. So I'm very excited about this talk, and I'm happy to be here.
Awesome, great. Corey?
Hey guys, I'm Corey Kaplan from the DeFi Money Market Foundation, one of the co-founders of DMM and acting CTO. We are building an interest-earning protocol that's uncorrelated from the rest of the market, attempting to provide stable yield to on-chain DeFi participants. And we're doing this by tokenizing real-world assets in pools and offering them as interest-earning tokens to our users. Really excited to be here and talk about the landscape with you guys and talk about more of the things that we're doing and trying to accomplish with Chainlink.
Awesome, great. So let's just dive right in many ways, if you think about financial systems and capital markets, just kind of stripping it down, in a way it's like a game. Have you guys been following this cross-section of gaming, memes, DeFi that we're seeing emerge, especially like I would say over the last few weeks, kind of came by storm, especially with like Aavegotchi and Pineapple. How do you think we'll see DeFi interact with gaming going forward, and if this is a continued trend? Anyone feel free to jump in with that.
I guess maybe I can start here.
Yeah.
So for Axie Infinity, I think we are a little bit before the trend. So I'm going to start, I think, with the first collaboration that we had with MakerDAO, which was, I think, quite some time ago. So the idea there was that for those players or for those people who had opened up CDPs, they were able to claim a specific set of items inside our game universe. So if you had a CDP with $150, you got the lowest tier of item. Then you had one with $1,500, you got the mid tier, and then if you had over $15,000 worth of collateral locked in a CDP, you got the highest tier of items. And I think these kind of collaborations make a lot of sense between gaming and DeFi. We've done also similar things with, for example, Kyber Network. What we see now in terms of this whole yield farming craze, and I would say Aavegotchi is probably way more on the DeFi specific side than we are on more of the gaming side. I think both aspects have a very kind of a clear use case, and I find Aavegotchi to be very exciting. But for me, the real value between DeFi and gaming is more in kind of the interoperability between the ways of basically you can tap into liquidity from, for example, Uniswap. And we've seen that happen with some of the items that players can find in our games. So I'm very excited about that. And I think it's definitely a value add for games. It's just that we haven't really seen too many games kind of tap into that yet.
Yeah, I think an interesting point on top of that is one of the best parts of that has made DeFi take off in this way is the gamification of different aspects of these protocols in order to be able to provide extra incentives or make the protocol interaction a bit more fun. Like the concept of yield farming, just in of itself, the name for it is quite interesting, and it lends itself to a lot of curiosity of what it is, how it works, why I should be doing this, and why is it potentially lucrative to interact with in the first place. As far as the interaction, I think that a lot of the cross examination between a lot of the gaming things that are being built, as well as the cross section of that of DeFi, is that a lot of the stuff is built upon the tokenization of key things, whether it's NFTs, non-fungible tokens, or fungible tokens themselves, like ERC20s, or things that are compatible with ERC20. And you can see a lot of them actually be able to be fit into a DeFi landscape essentially very easily, whether it's decentralized exchanges or prediction markets or auctions that have been occurring or things like that. I think that it's going to lend itself to a lot of composability, which is exciting, which is, I guess, one of the big things that we're talking about today, as well as gamification schemes that lead to rewards for interesting interactions with these games in the first place or these protocols.
I have to very much agree there. I think the key part is that fun aspect. You know, a lot of games are chasing the high score, and I think at the moment people are chasing the high scores of yield farming and different DeFi activities. For me, the conversation of DeFi and gaming really happened a while ago with Pool Together. And the fact that you can earn interest by essentially saving your money. And coming from the UK, we have something called premium bonds, which are exactly the same system. You buy premium bonds and you're entered into a regular lottery to win the interest from all of that money that's been pulled together. And so I think the ability to make activities fun, it'll be really interesting to see how we turn that into incentivizing people to make clever, sensible, probably also stupid financial decisions. And I think fun is a key part of interaction with these products. But also what you were saying, Alexander, about the composability. I was reading a few days ago, CoinDesk had a great article about people playing Axie Infinity, or basically earning money through Axie Infinity. gathering the love potions, breeding axes and trading them, and really creating their own game, because you also have to compete with Ethereum congestion and gas fees to make sure you still have a margin in the ads you're spending in the game. But all of that wouldn't be possible if there was the whole DeFi infrastructure like Uniswap surrounding the game that you can plug into easily. And it's going to be fascinating. Getting more games interact with that infrastructure, and also the reverse, as we see with Arbogotchi, games being created which plug into DeFi activity. And engine adopters are building their own virtual economies in their games. So I'm very excited to see how players are going to work them to their own advantage. We have the 6 Dragons putting out recipes to enable others to blacksmith special items. And in 9 Lives Arena, people are breeding these Oogie aliens to mine and craft for you 24/7. So really excited to see gaming and DeFi come closer together and also create completely new projects.
Awesome, great. Kind of on that note, especially when it comes to composability, which is a conversation as far as like putting different Legos together and making something a cohesive product, which is a good user experience, is something that a lot of folks in this space talk about. So do you guys think it's possible that perhaps like solving this UX UI problem that actually be that on-ramp for DeFi, especially when it comes to composability and composing these different products together?
I think for me, it's not really a UX UI problem for DeFi. It's more blockchain overall. So I was always excited about sort of Engine's role in this space because of that blockchain gaming element. People were saying, gaming will be the entry point for using blockchain, despite the friction that exists. And gaming is an industry which has a huge amount of research and development going into creating experience that attract and also retain users. So it is a space that's constantly analyzing user behavior and working that to people's advantage. So actually what we've seen recently with Engine's projects is that it's been enterprise demand has been really driving us to improve user experience. And that's because they love the technology, but we need to reduce the friction of interacting with the technology in order for these products to be used by existing employees and communities. And I think the same goes for gaming. We need to learn from gaming and creating very enjoyable, pleasant, easy experiences that are addictive, for better or for worse.
I think just also adding to that, if you look at the landscape back in 2017 or so, and we had one of the first very large manias around smart contract platforms. As developers, we had a lot of assumptions around what the users would be able to do or not be able to handle at the time that were proven to, for better or for worse, incorrect or correct in certain areas. And I think now at this point, now that there's been a lot of shakeout and a lot more scaffolding put in place, be it developer SDKs or new technology has been built on top of the existing infrastructure. A lot of the developers and engineers are now building things with a UX experience, user experience in mind from the get-go, instead of just taking certain leaps and hurdles that like every user will download MetaMask, every user will now have this wallet. We now have a lot of assumptions, which is people will interact from their phones, from different wallets, from desktop, from different areas of the world. And there's a lot of tooling being built around making that onboarding experience as easy as possible. And then also the experience of interacting with the applications from there on forth also as easy as possible. I mean, speaking less so on the gaming part of it, like USDC with Circle this other day released gasless requests, or was it 2 days ago? But regardless, it was a very big step forward for decreasing friction with very simple things like gas payments for users to be able to interact with very, very large and prominent tokens. And I'm sure that games are also taking similar steps forward to reduce friction as well.
Actually, I am 100% convinced that is going to happen. Basically, that games will be the on-ramp for DeFi. So coming from the gaming space, like being here since the very early stages of the blockchain gaming, kind of where it all started, I think we saw a lot of projects come into the space. They were thinking that they were going to work in the traditional gaming space and then turn. The fact is that making a blockchain game is much more like making a network in itself, where you actually have to deal with how people are thinking in terms of incentives. And you also need to consider everything in the broader network aspect of it. And instead of just like this one game, everything is connected. So that goes back to what Alex said about the small love potion, which actually for us was kind of this early experiment to see what would happen if we released it initially without any pre-mine, because that's very kind of a crypto word, but we didn't even sell it. It was just kind of this way that people could earn it through the game. And I think that's also a very early kind of yield farming thing, really. But one thing about the DeFi space right now is that I am actually not convinced that there are so many new users coming in. It's pretty much the same people, from my perspective at least, that are playing these money games and kind of dumping on each other. I think with games we have a new chance, but while it's about the user experience for sure, it's also a lot about the way that you design these games. So even if you have a great user experience, if there is no way for them to kind of go deeper into the game that you are designing, like there is no foundation, why would they even stick around? At that point, there is nothing special about it. There's nothing magic. But for DeFi, it's much easier because they can just simply copy and paste the existing, all the existing kind of financial applications, I should say, or the things in the financial space, and kind of decentralize it. For games, it's much harder actually, because it doesn't really make sense to decentralize a game immediately. You have to come at it from a different mindset.
Awesome, Alexander, I love that answer. Very saucy take. I appreciate that. No, I guess kind of on that note, when you were speaking of networks as well, when you start creating this like virtual world through a game with real economic assets, then you have to start thinking about that network, decisions, governance. Thus, then we start getting this idea of DAOs. We have Decentraland I've seen, and other kind of gaming DAOs slowly emerging. Do you guys have any thoughts there? Is that something you guys are considering? Would love to just hear your thoughts as far as like gaming DAOs and how that's going.
Yeah, so I think that actually connects very well to kind of what I was speaking to just now. So with Axie, we kind of started out only with non-fungible tokens, or these unique game characters where people could kind of use them. And then because we actually thought that there was only shit coins around, like they didn't even make any sense. Why would you have a coin like just to use for payment? Like when you can just use Ethereum or Ether or Bitcoin or DAI or these kind of things, like it doesn't make sense to have just lock in for currency. There needs to be more things. And then kind of you come to the kind of the natural next step, which is a governance token or some kind of way to make the people who are participating, like adding value to your game or to your network, how can they actually participate in the value that's being created and kind of drive that value creation by interacting with the token. And I think that's the kind of the key aspect of a DAO too. Like the people need to be able to earn the ownership aspect, the kind of the token, by creating value for the platform or the game that you are creating. And that's exactly what we're going to do in Axie. So it's still a little bit kind of secrets. Things have started to leak out a little bit, but we're going kind of to be opening up the platform more in terms of ownership and governance. But the thing is, in terms of games, as I mentioned, like it's much harder to make a sustainable thing that lasts for a really, really long time without a ship captain. So I see it's happening in DeFi all the time. Like these platforms are coming out, they're saying, okay, now it's decentralized. But that for games, like you really need to have that grand vision design. You need to be pushing forward for many, many years. So that's why I don't think it makes sense to do it immediately. But what you can do is you can start distributing this token and then progressively decentralize the platform or game that you're creating through that, as long as you have like a clear roadmap. So that's kind of a secret too, but yeah, that's happening in Axie. And I'm very excited to see other kind of game protocols or games do that as well.
Awesome. Anyone else have thoughts on DAOs and gaming? And
yeah, I think overall, a lot of the things that Alexander said were very applicable to the construction of a DAO and where the value creation is really it's essentially sucked in by the community and really grabbed a hold of through them. And speaking for the DeFi money market ecosystem, we're looking at similar ways to be able to do that. Of course, with us being more of a financially driven application instead of a game, things are definitely a bit easier on us for it. Essentially because the value accrual as an ecosystem participant is a bit more clear, as opposed to this ship captain that Alexander was alluding to, which I don't envy the challenge you guys have trying to design that, especially for the long term. That sounds very difficult. But for us in particular, there's some very clear-cut ways where ecosystem participants can add liquidity to certain areas and then essentially be providing value back to the ecosystem, which is something heavy I want to talk about a bit later in our chat today. But it's something that we've actually been designing with our concept of yield farming, which is our take on it. And it's a bit different for our ecosystem compared to others just because of our ecosystem being a little bit different from other ecosystems. But overall, I think that there's this really interesting idea of being able to use a native token for an ecosystem to align incentives of everyone that's in the ecosystem as well, and being able to provide value back to it. And then, of course, being rewarded for it too. It kind of gives use cases beyond the initial, I'm going to use my token as a payment mechanism, but it also is used to, like I said, align incentives then, as well as flex and be flexible over time to be able to match the needs of an evolving ecosystem and DAO that's behind it then.
Yeah, I think it's going to be fascinating watching these projects evolve and try and move towards more decentralized states. It's going to be an area that many people will learn from. I think a lot of things are going to be broken before they work, and it's going to be a really exciting process to watch. I think in terms of the gaming space that I'm seeing, what's really cool to see is that projects are already being advanced in a very collaborative manner, where instead of perhaps doing an equity share or revenue share, people are being rewarded with NFTs and game assets for their contributions, whether that be community management, art design, or actual development. And so it's really interesting seeing these communities built around the shared game assets, and how they decide to govern themselves and interact with one another is going to be fascinating to see, and lead to a lot of lessons learned there. Also, in terms of the sort of esports space, having very interesting conversations and seeing actually within the Engine community itself, games that are in closed alpha, which are very sort of competitive, they're already forming up their own sort of esports organizations and strategies. And this idea that you could have sort of esports DAOs where people pool powerful or interesting game assets, which can be shared by the community. And then when it comes to time for a tournament, you can put forward your best player, supply them with the best of your assets, and go tackle other esports DAOs. I think we're going to see all sorts of interesting scenarios brought out like that. And the most exciting parts are still yet to come. But the genesis of those ideas and projects, I'm already seeing in the projects that Engine's working with and building. So it's really, really cool.
That's great. And congratulations. You guys are crushing it. So I guess now that we're at, just to table set here, we are at the Smart Contract Summit. It'd be great to try to understand how Chainlink specifically feeds into what you're doing. So, if you think about it, Chainlink is the bridge to the real world in many of these virtual realities or gaming realities. Can you each explain how Chainlink plays a role in the architecture and the importance of oracles in your smart contract? And if you haven't yet, are there ways that you plan on using it in the future? And it would just be great to hear more about that and what you guys are using Chainlink for. I don't know who wants to go first here.
I'll jump in. I love the Chainlink team. Also, thank you to everyone, Rory. Thanks for organizing this whole conference. And oracles are incredibly important in this space, and they're going to be used in very interesting ways. Actually, a later session, one of the Engine adopted projects, Savas of the Six Dragons, he'll be speaking on a Chainlink solution that he's using. So I won't spoil that, but definitely do tune in for random number generation. I'm really excited for oracles bringing real-world dynamic data to NFTs, and I think that's going to be a fascinating space to watch develop. And I think this is very much watch this space and see what happens, because linking that dynamic data to virtual economies and virtual assets is going to become very exciting very quickly.
Actually, on that note, I'm kind of curious, what kind of data do you think would be relevant for what you're building, or is there any specific kind of? Because I'm not a massive gamer, but I like to pay attention to the space, and so it'd be kind of interesting to think about like the real world interacting with this gaming world. Are there like specific pieces of data you think could really add to this virtual world that could make it more real?
I think one example we see a lot of conversations around would be sports games, where you collect virtual versions of real world sports players, and week by week, their abilities and attributes change based on the real world performance. I mean, there are already games that operate like that, and I think linking them to oracles and making basically enhancing all of those features will be exciting to see. But yeah, sports is kind of the obvious answer there, and I think a lot of projects are already exploring that space.
Awesome. Corey, I'd love to hear about how you're using Chainlink, or if you guys have thought about it.
Yeah, the way that we're using them right now, and also the way that we're expanding our use case, is definitely interesting and quite different compared to other ecosystem players. In particular, with what we're doing, because we also are tied to these real world assets, as we keep alluding to, as we want to potentially onboard new assets. So right now we're working with, in particular, car equity lines of credit or special financial instruments surrounding cars. As we want to expand that use case to, for example, we're exploring onboarding 2 PC-12 aircraft, private aviation. Chainlink's actually going to be a part of the trustless process of being able to accept those assets into the ecosystem through essentially a couple new Chainlink adapters that we're developing with them. With that, there's also some movement of crypto into fiat or into real-world dollars that occurs in order for us to be able to tokenize these assets. We're actually working with Chainlink in order to be able to track the movement of fiat funds in order to maximize transparency of where dollars are when they're not actually locked up in an asset pool. So kind of like when it's in like that in-transit process, but not when it's in crypto, because then obviously when it's in crypto, everyone can see it. And not quite when it's already in an asset pool because Chainlink's already tracking that, but rather when it's in that limbo in-between stage, which could take a couple business days depending on the flow of fiat funds. So there's a couple really interesting things like that we're trying to work on that Chainlink makes possible, because otherwise this entire process would be the opposite of trustless. So you have to trust the foundation / DAO running behind this completely in order for this to work properly. But instead, Chainlink is able to offer transparency and a level of trustlessness into the ecosystem that wouldn't have been there otherwise. And I think that things that staking that they're adding into on a protocol level will make a very big difference into deterring node operators in the Chainlink ecosystem from otherwise manipulating this data, doing bad things to it. Because if, for example, them manipulating this data would result in them losing their stake completely, it'll otherwise act as a financial deterrent from them doing anything nefarious. So there's some really interesting things going on that will help with not just building out these really large use cases that are potentially securing even more money than it already is right now, but it'll also help with further aligning incentives of these independent node operators with the data they're actually retrieving then.
Interesting.
Yeah, so I guess I'll have to leak a little bit here. So for Axie, we haven't actually officially announced anything with Chainlink, but the story there is quite long. So we've been doing our own way of randomization things for quite some time. So in Axie, for example, whenever you breed 2 Axies, it sends a call to a contract. And then there is all this fancy stuff, which then again leads to popping out a brand new Axie. And to avoid that people are kind of, or not hacking that, but kind of listening in on a call, there's all these things in the background, which we've actually made ourselves for now. And when we already tapped into something called Oracleize for some time too. But what is basically happening is that there are so many things inside games that requires like randomization and using oracles that we've been looking for a solution for quite some time. So we've been in touch with the Chainlink team. I met Dan in Korea last year. So it's been a lot of back and forth, and we are now almost getting ready to announce something, but I can't say exactly what it's going to be, but we're also going to be, we're doing our own sidechain for Axie Infinity, and there's definitely a possibility that Chainlink will be one of the providers on that chain. So
great. I'm looking forward to hearing about that. And I guess in the word of Link Marines, soon. That's like their big meme, but soon or tonight.
Maybe soon. We'll see.
I don't know. So on that note, I mean, we have to wrap. Unfortunately, I could continue talking about this, but any last words, or if someone wants to do that, feel free just to give your quick wrap here.
Yeah, so for me, you can find me on Twitter. My handle is @psychout86. And you should also definitely join the Axie Infinity Discord to see that there is real adoption happening right in front of our very eyes, that people are actually using these crypto projects and crypto game products. So yeah.
Awesome. The best way to reach me would be at Twitter as well, Corey Kaplan 3. Right now, our Telegram and Discord are quite used as well for the DeFi money market community. And then with that, also, we're excited to announce that next week we're going to be actually rolling out our proposal for onboarding yield farming into our ecosystem. And we'll be releasing more details on what that will look like and how it's going to actually work then. But really excited to be able to have the opportunity to speak here with you guys. It's been a pleasure. Thank you.
Yeah, it's been a huge pleasure speaking with you guys. And I guess the audience, stick around for more of me talking about Engine's scaling solution on Ethereum.
Awesome.
Thank you, guys.
Thank you, everybody.
Bye, guys.
So we'll be right back in about 10 minutes. Brianka's going to lead another session. So in the meantime, take a break, hop into the other sessions, get into some networking, hop around for a bit. Yeah, outside of that, we'll be back in 10 minutes.